Hello, listeners. Welcome to the Credit Compass, helping you navigate the world of European credit, where we break down the biggest moves in credit markets, macro trends, and fixed income strategies, shaping the financial landscape in Europe and the UK. My name is Gordon Kerr, European macro strategist and host. In this episode, we'll delve into the UK's spring statement and highlight some corporate activity ahead of US President Trump's Liberation Day, or T-Day as some are calling it, where tariff announcements are expected to present a full picture. We will examine forward-looking statements from recent annual reports of European companies, providing insights into their strategic outlooks amidst the current economic landscape. Let's get started with the UK. On the 26th of March, Chancellor Rachel Reeves presented the UK's spring statement, outlining a comprehensive plan to address fiscal challenges and stimulate economic growth. In the past, the UK government used to have budget adjustments every 6 months, but in 2018, the then Conservative government migrated to a single budget exercise in the autumn, followed by an update statement where the Chancellor gives an update on the state of the economy and details progress made to date. This year, the spring statement proved to be a little more than just a statement. Instead, it focused on government plans for cuts and where they will be investing for their growth plans. The key measures announced include welfare reforms, where the government plans to implement welfare reforms that could save up to $4.8 billion by 2029 to 2030. These reforms aim to create a more pro-work welfare system, encouraging employment while ensuring support for those unable to work. She also announced some departmental spending cuts, a reduction of $3.6 billion in day-to-day departmental spending, which has been outlined, focusing on increasing efficiency within public services without compromising essential functions. Further to this was the much-anticipated defense spending, and has been flagged both in Europe as well as the UK. An additional $2.2 billion will be allocated to the Ministry of Defence next year, contributing to the UK's goal of increasing defence spending to the targeted 2.5% of GDP by April 2027. This investment aims to bolster national security and help drive economic growth through advancements in research and development focused on the defence sector. Also in the statement was capital investment plans. The government is currently committing to an average increase of $2 billion per year in capital investment over the next 5 years. This funding will support infrastructure projects, including the construction of 1.5 million homes by the end of the decade, aiming to stimulate the construction industry and help to address housing shortages. Further to this, the public sector transformation will have a $3.25 billion fund established to drive efficiencies across government departments. This initiative focuses on integrating digital technologies and artificial intelligence to help modernize public services and aim to reduce long-term costs and enhance service delivery. All of this is needed adjustment as the Office for Budget Responsibility has revised the UK's economic growth forecast for 2025 downward to 1%, reflecting the challenges facing the economy. The UK is likely to see sluggish growth in the first quarter once the numbers are finally out, and in our view, this is likely now to leak into the second quarter as well, despite Reeves and Sir Keir Starmer's best efforts. The government's strategic investments and reforms are designed to lay the groundwork for sustainable growth and improved public finances in the medium to long term. This slowdown period is hopefully setting the groundwork for growth in the second half. The bond market had little reaction to the spring statement, suggesting that this is kind of in line with expectations and unlikely to have an outsized impact on growth in either direction. However, the Bank of England is still struggling to tame inflation, with wage inflation and inflation expectations still high. This could keep rates higher for longer and choke off the potential for growth that Reeves is hoping for. However, with the UK, there are more underlying problems than just inflation. Sir Keir, it's time to get on the road and start signing those trade deals and benefits that we were all promised as a part of Brexit. Now, speaking of trade, this podcast was recorded ahead of the much advertised Liberation Day on the 2nd of April. Today, if you are listening to this podcast upon its release, where the US President Donald Trump will announce his planned tariffs on countries and products above those already announced and in discussion. We will do our best to cover the potential impact of these in the next week's episode. In light of these impending tariffs, several major European companies have already provided insights into their earnings and revenue expectations, as well as strategic responses. Let's focus on one of the biggest sectors to be impacted, autos. For starters, Aston Martin has announced plans to raise over $125 million to counteract the anticipated financial strain from tariffs on vehicles exported to the US. The company projects £30 million reduction in gross profit due to these tariffs. To address this, Aston Martin intends to sell its minority stake in the Formula One racing team and secure additional investment from Chairman Lawrence Stroll's consortium. Furthermore, the company plans to increase vehicle prices, implement cost reductions, and enhance customization options to improve their profit margins. The U.S. market, accounting for 30% of Aston Martin's sales, is a significant focus in these strategic adjustments. Mercedes-Benz is proactively increasing its U.S. inventory levels ahead of the tariff implementation. A potential 25% tariff on auto imports to the U.S. market is expected to reduce Mercedes-Benz's gross margin by 2.5 percentage points. Despite these challenges, as of the latest comments, they are anticipating earnings of $1.75 billion on a margin of 6.4%. However, a slight decline in sales has been noted in the first quarter, attributed to weaker performances in China and Europe. In 2024, Mercedes-Benz sold 374,000 vehicles in the U.S., representing 15.5% of their global sales. Next, one of my dream cars, Ferrari, although being over 6 foot and not having enough money to justify it, I am not likely to ever own one. They have announced price increases of up to 10% on select models in response to auto tariffs. While the company will absorb some of the additional costs, some models will maintain current pricing. Despite anticipating a potential 50 basis point reduction in EBITDA and EBIT margins, Ferrari upholds its financial targets for 2025. The U.S. market remains crucial, accounting for approximately 40% of Ferrari's global sales. Volkswagen had already begun to shift some manufacturing to the U.S. and would also be heavily impacted as a large proportion of their vehicles sold in the U.S. come from Mexico. Broadly speaking, European carmakers will be most impacted by the import tariffs. European car manufacturers export vehicles and components worth $40 billion to the U.S., accounting for 20% of the EU's total automotive export value. Outside of the autos, the broader global corporate executive is worried about the cost impact of tariffs, and they are investing into their supply chain adjustments. For example, according to Bain & Company's Operations Executive Survey done earlier this year, 40% of their approximately 181 survey respondents expect double-digit input price increases. 80% expect to revise their financial forecasts and have already started to reallocate funding into supply chains and technology over making debt payments and dividends. These changes are expected to be funded through cost reduction programs and internal cash reserves. This highlights the boardroom decisions that are happening despite the lack of clarity that everyone is hoping for and is expecting to see on the 2nd of April. For credit markets, the uncertainty has started to weaken prior resolve, with credit spreads reaching their highest levels for the year and nearing the peaks reached on several occasions in 2024. However, they still pale in comparison to spread levels seen in 2022 and 2023. With rates remaining high, the argument for fixed income investment continues to hold appeal as high outright yields offer attractive returns to equities. Even though European equities have attracted some significant interest this year as a global diversification play. So, in summary, the UK struggles on as it tries to improve its growth potential and build foundations for change, but nothing is likely to move the needle significantly in the first part of the year. While growth has yet to really pick up in Europe, Brussels has received the message that it is needed and has been taking action, as we have highlighted on a number of occasions. European companies are actively implementing strategic measures to mitigate the anticipated impacts of the forthcoming U.S. tariffs, and financial restructuring, inventory adjustments, and pricing strategies will all play their part as European firms aim to navigate the challenges ahead while maintaining their financial stability and market presence. Thank you for joining us. That's all for today. And thanks again for tuning in to the Credit Compass. Be sure to subscribe for more insights, and we'll speak to you all again soon. As always, staying informed is key to navigating these complexities. And until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.